Today, King Dollar runs ahead of upcoming data. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Well, the US dollar surged to a new 20-year high on Tuesday, gaining near parity with the euro, and it remains strong against the Japanese yen, in particular, on fears about the global growth outlook ahead of the release later in the week of key US inflation data. The US currency has gained on expectations that the Fed will continue to progressively raise rates as it tackles soaring inflation. The dollar index, which tracks the greenback against a basket of 6 other currencies, traded higher to 108.21, climbing to levels not seen since the start of 2002. The US dollar Japanese yen closed at 136.81, climbing as high as 137.26 in the trading, and that's the highest since late 1998, a 24-year peak. And the yen's weakness accelerated after Japan's ruling coalition expanded its majority on Sunday's upper house election, suggesting that the voting public remains behind the country's super easy monetary policy. And the Bank of Japan governor added to that sentiment by stating earlier in the day that the central bank won't hesitate to take additional monetary easing steps as necessary. The Japanese central bank's soft monetary policy stance has been at odds with most of its contemporaries, as most major central banks, and the US Federal Reserve in particular, have started aggressively raising interest rates to combat soaring inflation. The euro-US dollar fell to 1.0031. That headed towards the 20-year intraday low hit last Friday, with the risk of a recession in the Eurozone growing as the likelihood of an energy crisis in the region rises. The pound US dollar fell to 1.1880, with the political uncertainty surrounding the ruling Conservative Party's choice of the next leader and Prime Minister weighing on sterling. And the risk-sensitive Aussie dollar fell 0.16% to 67.45, while the New Zealand US dollar dropped 0.24% to 61.22, and the US dollar Canadian dollar rose 0.07% to 1.303. Now that's ahead of the Reserve Bank of New Zealand and the Bank of Canada's later meetings, both due, of course, this week, and in fact the Reserve Bank of New Zealand reports at 2 p.m. New Zealand time today. And Wall Street ended in negative territory on Tuesday as growing signs of recession kept buyers out of the equities market ahead of the inflation data coming later. While all 3 major stock indices seesawed between modest gains and losses earlier in the session, they turned sharply lower late in the day as Wednesday's consumer prices report from the Labour Department drew near, with big bank earnings looming later in the week. Market participants are wary in a week back-ended with critical inflation data and the unofficial beginning of second quarter earnings season results. It's a nervous market, said Rob Hayworth, Senior Investment Strategist at US Bank Wealth Management in Seattle. It's all about the kickoff to earnings season and what the inflation data tells us. We know inflation is being driven by supply constraints and China is an important factor, he said. And later in the week, a raft of economic data, including consumer prices, retail sales and factory output, could provide a glimpse of the extent to which inflation has peaked and the economy has cooled down as the Federal Reserve moves closer to the next policy meeting, which is expected to bring in a straight 75 basis point interest rate hike. The latest US Consumer Price Index is due on Wednesday, and it's expected to show an 8.8% year-over-year increase and a 1.1% month-over-month increase. In combination with Friday's strong non-farm payroll release, this does point to another Fed interest rate hike of 75 basis points, which is likely to have a negative impact on global growth. The market is trying to caution its way ahead of that CPI print, Hayworth said. We're hoping for a slowdown, which would put the Federal Reserve in a softer stance, but on the other hand, there are lots of reasons to believe inflation could stay high and the Fed will remain aggressive. Investors are waiting to hear what happens with CPI and earnings, said Brent Schultz, Chief Investment Officer at Northwestern Mutual Wealth Management Company. For several months, we've swung back and forth between inflation fears and recession fears almost on a daily basis. We really have confused investors who have chosen to go on a buyer's strike, he added. I don't hear many people saying, buy the dip now. While the CPI report is expected to show inflation gathered heat in June, the so-called core CPI, which strips out volatile food and energy prices, is seen offering further confirmation that inflation has peaked, which could potentially convince the Federal Reserve to ease on its policy tightening in the autumn, but we'll see. Paul Kim, Chief Executive Officer at Simplify ETFs in New York, expects year-on-year top-line CPI to be the high 8 or potentially even 9% range. With inflation that high, the Fed has only one thing in mind. Worries that overly aggressive moves by the Fed to rein in decade-high inflation could push the economy over the brink to recession were exacerbated by the steepest inversion of the 2- and 10-year Treasury yields since at least March 2010, a potential signal of near-term risk and economic contraction. And if the Fed did raise the rates by another 75 basis points, that would mark the third consecutive interest rate hike. The Dow Jones Industrial Average fell 192 points, or 0.62%, to 30,981. The S&P 500 lost 0.92% to 3,818, and the Nasdaq dropped 0.95% to 11,264. All major 11 sectors of the S&P 500 fell, with energy shares weighed down by plunging crude oil prices suffering the largest percentage losses. The second quarter reporting season will hit full stride later in the week as JP Morgan Chase, Morgan Stanley, Citigroup and Wells Fargo all post their results. And as at last Friday, analysts saw aggregate S&P earnings growth of 5.7% for April to June periods, down from 6.8% forecast at the beginning of the quarter. And of course, that is the question: what will earnings growth look like? PepsiCo got the ball rolling this week by beating its quarterly earnings estimates and announced it would increase prices amid resilient demand. And shares at Boeing jumped 7.4% after the plane maker's June aircraft deliveries hit the highest monthly level since March 2019. And that news, along with the falling energy prices, helped the S&P 1500 Airlines Index rise 6.1%. Apparel retailer Gap fell 5% following its announcement that its CEO would step down, and that margins would stand under pressure in the second quarter due to input costs. And software provider ServiceNow plunged 12.7% after its CEO's remarks about macro headwinds and currency pressures. Other software companies, including Salesforce, Paycom, Intuit, and Microsoft, were also down. Analysts expect steep plunges on year-on-year profits as the companies grow their loan loss reserves, fueling fears of impending recession. And Twitter formally sued Elon Musk on Tuesday for violating his $44 billion deal to buy the social media platform, and asked the Delaware court to order the world's richest person to complete the merger at the agreed $54.20 per Twitter share. Musk apparently believes that he, unlike any other party subject to Delaware contract law, is free to change his mind, trash the company, disrupt its operations, destroy stockholder value, and walk away, said the complaint. The lawsuit sets in motion what promises to be one of the biggest legal showdowns in Wall Street history, involving one of the business world's most colourful entrepreneurs in a case that will turn on staid contract language. On Friday, Musk said he was terminating the deal because Twitter violated the agreement by failing to respond to requests for information regarding fake or spam accounts on the platform, which is fundamental to its business performance. Musk, who is the chief executive officer of electric vehicle maker Tesla, did not comment immediately on the update. The lawsuit accused Musk of a long list of violations of the merger agreement that had cast a pall over Twitter and its business. It said for the first time that employee attrition had been on the upswing since the deal was announced. And Twitter also accused Musk of secretly accumulating shares in the company between January and March without properly disclosing his substantial purchases to regulators, and said he instead kept amassing Twitter stock, with the market none the wiser. Shares of the social media platform closed at $34.06 on Tuesday. That's up 4.3%, but sharply below the levels above $50 where it traded when the deal was accepted by Twitter's board in late April. The stock added another 1% after the bell. And in China, Shanghai reported its first cases of the highly infectious BA.5 Omicron subvariant last Sunday and warned of very high risks, stoking fears of more lockdowns. Beijing has also vowed to shore up the economy. The dollar could remain expensive until the risks around elevated global inflation, European energy sector and China's growth outlook has been resolved, Barclays analyst said in the note. Also weighing on stocks was the prospects of shutdowns in China because of COVID. Several cities are imposing new restrictions, including the gaming centre of Macau. That is weighing on casino stocks such as Las Vegas Sands Corporation, which dropped 6% on Monday, but was up 3.23% on Tuesday, while Wynn Resources dropped 6.4% on Monday and then rose 3.64% on Tuesday. And in Europe, Germany, the region's largest economy, is more likely than not to see economic output shrink, given its vulnerability to cutbacks in Russian energy flows. The biggest single pipeline carrying Russian gas to Germany, the Nord Stream 1 pipeline, began annual maintenance on Monday, with flows expected to stop for at least 10 days. But of course, the question is, will they reopen? Governments, markets and companies are worried the shutdown might be extended because of the war in Ukraine. The most proximate concern for markets is whether or not Nord Stream 1 is going to come back online, said Biden Ray, North American head of FX strategy at CIBC Capital Markets, adding that the markets will likely price in a recession for the region if it doesn't. The Australian dollar was the worst performer on the day, falling to a 2-year low on global growth fears. Multiple Chinese cities have adopted fresh COVID-19 codes, from businesses to halt the lockdowns to rein in new infections, which could create new supply disruptions. And in the cryptocurrency market, Bitcoin fell 2.4% to 19,335 and Ether was down 4.06% to 1,040. And central banks will have to make a fundamental decision on cross-border access for a digital version of their currency to serve as a means of payment. A committee at the Bank for International Settlements said central banks must make critical choices on the access of non-resident and foreign financial institutions to central bank digital currencies, as well as ensuring multinational interoperability to fully harness the potential for central bank digital currencies to enhance cross-border payments. The BIS committee said in a statement, well, if that doesn't sound like a global currency by another name, I don't know what does. Lots going on, lots more to come this week. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.